In today's video, we answer the question, are refinance rates higher than the rates you see online, or purchase rates or posted rates, however you want to look at it? You know, a lot of people ask me this question, and so instead of just answering one person at a time, I kind of want to go on the old adage of, you know, if you have a question, chances are somebody else has it too. So my name is Matt Kelly. I'm a mortgage agent with Mortgage Architects, based out of the London, St. Thomas area. My license allows me basically to serve anybody in Ontario, but it's not a pitch about me. I'm here to answer that question. So here's the question: are refinance rates higher? Generally speaking, no, they're not. There's two major exceptions to that, so let's get into that. Rates, the first one is, look, rates have increased since you purchased your home. If this is the case, you're probably not looking to refinance unless either you're looking to pay off some debt, or maybe you're looking at some sort of interest rate arbitrage opportunity. Now, the second and the more common situation is when you're shifting from an insured mortgage to an uninsured mortgage. Let's look at it this way. You know, lenders, because insurers take a little bit of the risk away from lenders here, they often offer a little bit of a rate discount. Now, mortgages are not all about rates, but that is what this question is about. So when a mortgage is insured, like I said, there's about a 10 basis point decrease, which roughly equates to about $5 to $7 per $100,000 you're borrowing. Now, let's make this real, let's make this practical and tactical, because there's another reason, or there's another way I have this question asked to me. For a minute, I want you to put yourself in this young couple's shoes. Let's call them Joey and Jesse. They've called me because they're looking at refinancing their home because, you know, they bought it 2 years ago, the markets went crazy, and more importantly, they're expecting their third kid. And so now they're looking for any cash flow savings they can get, and they're looking at, you know, taking what was their 25-year amortization on their original mortgage and extending it to a 30. So they're asking, okay, well, are rates higher? Well, we've kind of already went through it a little bit, but I want to stop and make a quick aside. Look, mortgages are about more than rate. So for example, there are some really restrictive mortgage products out there, and they're typically the ones with the lowest rates. And so there's something in the mortgage industry, it's called a BONAFIDE sales clause. So if Joey and Jesse's mortgage originally had this, it means the only way they would actually be able to break their mortgage is if they sold their home. Now, Joey and Jesse aren't looking to move. They just want to extend their amortization. So is it worth the measly savings you're going to get each month to not have the flexibility in your mortgage? Look, life is extremely variable, and so you're going to want the flexibility in your mortgage. Anyways, let's go back to Joey and Jesse, right? So they want to move on an insured mortgage. Typically, it's a less than 25-year amortization. On uninsured, you're looking at 25 and above. So Joey and Jesse are looking to not necessarily add money, but they're looking to increase their amortization, which is going to move them from the insured mortgage category to the uninsured mortgage category. So we know from talking about it earlier that this is going to come with a little bit of a rate premium, right? So we're going to see an extra $5 to $10 a month per $100,000 borrowed. Now, Joey and Jesse have about a $400,000 mortgage. Let's round it up to $400,000, and let's go on the high end of that scale, meaning that they're going to pay an extra $40 a month because of this premium. Now, when we extend the amortization out, what we're actually able to do is to save Joey and Jesse $55 a month because of extending the amortization. Yes, they're going to pay more in interest over the lifetime of their mortgage, but it meets their short-term need, which is to reduce their monthly expenses. So $55 that is per $100,000 borrowed. Well, we know they have a $400,000 mortgage, meaning that we're going to be able to save them $220 a month in their monthly mortgage payments, less what that rate premium is. $220 minus the $40 is $180. We're actually able to save them $180 a month by going through and refinancing. Look, as I said, and I've said a couple times in this video, mortgages are not all about rates. They're helping you achieve what you want to do. And so you have to ask yourself, and I don't mean this in a salesy way, is the extra $5 to $10 per $100,000 borrowed, or $40 on a $400,000 mortgage, is that worth more than you achieving your goals? Just some food for thought. I can't answer that question for you. It's only something that you can answer for yourself. If you know somebody who's considering refinancing and this video kind of triggered something for you, maybe consider sharing it with them. If it's something that, if this is a video you liked, please like it. Consider subscribing to the channels. And if you have any questions, feel free to drop them in the comment section. Thanks for tuning in today, guys. Have a great one.